everybody. Welcome back to the Peregrine Capital Hedge Fund Training Academy with myself, Alan Yates. Today I'm going to give you a quick introduction to Peregrine Capital and who we are, and maybe hopefully give you some confidence that we know what we're talking about when we talk about hedge funds. So let's dive right in. So first up, we started the business as a specialist hedge fund manager 26, almost 27 years ago. And I think the reason behind that genesis for Clive and Dave, who are our founders, was they wanted to utilize that wider toolkit that is available to hedge fund managers to produce the best possible risk-adjusted returns for our investors. So we are a specialist hedge fund manager. We only run hedge fund products, and I think that is because we believe this is the best vehicle for money management. And that's money management for ourselves as well. So we are collectively the second largest investor in our funds as staff. And I think that tells you that, first of all, our interests are aligned with yours and your clients' interests, in that we have significant skin in the game here. When our funds do well, we do well, and our clients do well. And that seems to me like a good way for things to be. The second thing to say to you is that by running hedge funds specifically, it gives us a couple of advantages. And those advantages are something that we think add significant value to us as a money manager. Now, the first is that as a long-only manager, you are often benchmarked against an index or whatever benchmark it is that one's mandate is against. Whereas for us, we are absolute return focused. So what that means is that we will only add positions to our portfolios where we think there's a really good reason to invest in that company or that idea. And so the return profile we're looking to generate is regardless of what markets are doing. It is an absolute return mandate, an absolute return mentality versus a mentality that is benchmark cognizant, if you will. Now, we're pretty specialist in the way that we manage funds. So we've only got really two offerings that we take to the market. The first is our high growth fund. This is a multi-asset hedge fund where we're aiming to deliver exceptional long-term risk-adjusted returns. And there's a lot of focus on that risk-adjusted element. Investors come to us, I think, because they are looking for equity market beating returns, but at significantly lower levels of market drawdown, significantly lower levels of volatility. So if you look at the 5-year number there, at the moment it's sitting around 17% per annum from a return perspective. Those are obviously net of all fees, with a volatility that's pretty low. I mean, significantly lower than the market. It's less than half the market volatility. Now, incidentally, our high growth fund, is the first fund in South Africa that delivered 100 times capital to investors. So what that means is, to put it in perspective, is if somebody had given us R1 million on the day that the fund was opened, that money would currently be worth about 179 million rand today. So exceptional wealth generation over the long term, and that's what that fund's designed to do. Our pure hedge fund is a very different mandate. Our pure hedge fund is a market neutral hedge fund. So what that means is we're not trying to take big directional exposure to equity markets. We don't want to be dependent on equity markets in any shape or form to generate the returns that we're looking for from this product. This product is very absolute return focused, and what we're trying to achieve here is just the best level of consistency and downside protection that we possibly can. So obviously we want to make sure that we're generating returns that are significantly higher than inflation. Investors need that. You can't be sitting still. But at the same time, we want to be doing that in a way that just reduces the volatility as significantly as possible. So if you look there at the 5-year numbers, annualized return net of fees is about 12%, but the volatility is super low, like 4.4% currently. And that's what we're looking to deliver in this product. The pure hedge fund's been around since 1998. And since then, we've never had a negative return year in that fund. So I think that speaks to that mentality of absolute return quite nicely. Just to give you an introduction to the team and let you know that there's more than just me, we're currently a team of roughly 50 people with significant skill set, obviously, on the investment side of the business. When you're managing a hedge fund, it is that wider toolkit that we've spoken about and will speak about more. And you need guys that understand how to manage hedge money. And we certainly have that. So Dave Fraser, who's our co-founder, still our executive chairman, portfolio manager, and has been involved in the business since day one. Jacques Conradi is our CEO and portfolio manager, and I'm sure many of you will have heard Jacques speak in the past. Both of them have been with the business for a very long period of time, and actually I can say that for a number of the members of the investment team. We have a core team of guys who've been together for a long time, who have been specialists in managing hedge funds for a long time, who understand the skill set that's needed to manage hedge really, really well. And then I think it's very important to say to you that our clients are our partners, and we want them to be our partners for the long haul. For us, I think it's very important that we are generating the types of returns and the types of outcomes for our investors that keeps them happy for many, many years. A number of our investors have been with us for 20 years plus, and hopefully they would say to you that they are very happy investors in our funds. We want to make sure that we're generating the best possible risk-adjusted returns for our investors over that medium to long term so that they stay with us for the long haul. And I think it is due to that we are able to produce the kind of track record we can, because the investors that come to us and the investors that stay with us, they've come to us with a particular mandate, and as long as what our funds do what they say on the tin, I think that makes for very happy investors, and will hopefully make for very happy investors for you as well. If I talk just very quickly about how we kind of look to recruit talent and add staff to the industry, to our team from the industry, we have a very significant focus on trying to engage young people early on in their careers who are just super smart and super passionate about markets, and get them in early, train them in our philosophy. And the reason we want to do that is because if they come from another asset management with significant experience, they will have already been inculcated in a different philosophy, and very often it's going to be a philosophy from a long-only fund manager. And this, as I've said in many of these videos, the skill set that is required to manage hedge is actually quite different to the skill set required to manage long-only. And so we like to bring guys on early in their careers, guys that are just super passionate and want to live these funds and make this their life's work, and train them up in the philosophy for how we do things. I mentioned this earlier, but I think it is super important about why Peregrine Capital could be a good fit for you, and that is that we have a market-leading alignment of interest with our investors. One, because we are invested in the funds alongside you. I think the vast majority of all of our liquid net asset value sits in the funds alongside investors, because we really do believe that these are just the best places to compound our wealth over time. The second thing is to say that we're a totally independent, 100% staff-owned business. So our future is our own, and it means that we can obviously make decisions that we think are in the best interests of the longevity of Peregrine and the longevity of our customers. We want to make sure that we do what we're good at, that we stick to our knitting in that way, and that we just by generating the best possible risk-adjusted returns, that's how we attract investors to our funds, as opposed to trying to be all things to all people. So unlike most managers in South Africa, we have stuck to our knitting and being able to say, we manage hedge, we're hedge fund specialists, this is what we think we're good at, and this is what we're going to continue to do. So why hedge funds? I mean, it's a valid question. Why not look to manage long-only assets? I think for us it comes down to the fact that we think that additional toolkit that the hedge funds offer mean that you have the ability to generate returns irrespective of what the overall markets are doing. So that bi-directional investment strategy for us is just super important. And in terms of the way we like to utilize that, obviously from a shorting perspective, for us it's really about pair trades is the big portion of that book. Then things like special situations and option structures are important for us, specifically for generating uncorrelated return streams, so making sure that our portfolios are populated with ideas that are not all correlated to one particular macro variable or one particular market movement. And then from the option structure perspective, it's really about that downside protection, making sure that we are able to produce those returns regardless of what the market is doing, and protecting capital for investors when markets do sell off, as they invariably do. If I tell you a little bit about our investment process, I think that the main thing to say to you is that Peregrine Capital is a fundamental bottom-up valuation-focused investor. And what that means is that we are looking for the best ideas to populate our funds. Because we're not benchmark cognizant, because we're not a long-only manager that's looking to outperform a particular index, we can make sure that whatever ideas we put in the fund, we truly believe in. And that gives us the ability to be pretty flexible. It gives us the ability to generate returns that are not only beholden to the way the market performs. And I think that's a value add that a lot of investors come to us for. It's that we produce something different, a return stream that is different to their existing investment portfolios, and can hopefully do something different when markets are struggling as well. So what are the benefits, hopefully, for your investors if you do look to add hedge funds to the mix? I think the number one benefit for us is better risk-adjusted returns. And like I said earlier, it is really important to highlight that risk-adjusted element. If you look here, what I've given you is the performance of our two funds versus all the multi-asset income funds, low equity funds, high equity funds, and general equity funds that were available over the last 10 years. And what that shows you, I hope, is that we can produce those outsized returns without taking additional risk, with making sure that we produce these returns in the most consistent and stable way possible, and therefore adding something valuable to your overall investor portfolio. The other thing that I think is a benefit of our fund specifically, but hedge funds generally, is a low level of correlation to the overall market. Because we're not benchmark cognizant, because we have that additional toolkit, for all those reasons, you will find that our funds tend to behave very differently to the overall market and are not dependent on that market for its return profile. If you look at our, and again, on this chart, what we've done here is all those funds I mentioned on the chart before, their correlation versus the overall market relative to ours. And I think what's always telling for me on this slide is that most funds, including many of the low equity products, are kind of 75% correlated to the overall market, which means you are very much dependent on the market doing well in order for those funds to do well. If you look conversely at something like our pure hedge fund, it has almost no correlation to the overall market. The benefit of that, I hope, is pretty obvious in that it will generate returns independently of those other investments that your client has, independently of that portfolio that you put together for them, and therefore hopefully add something different to the mix. And when I talk about what we're looking to do, it's always about what are we doing in whatever risk bucket that you're looking. Now, for us, because we run those two funds, it's quite specific. So our pure hedge fund, given that it's that absolute return mandate, that market neutral mandate, we're looking to generate returns that are stable, consistently better than our peers in that stable fund category, but that we really are making sure that we protect on the downside and that we protect investor capital in a way that allows them to stay invested with us for the long term. High growth fund, there we are looking to outperform the market. We are looking to make sure that we generate the best risk-adjusted return possible while taking some exposure to equity markets. So in that fund, you will, I compare it to balanced funds on the slide, and the reason I do that is, first of all, from an asset class perspective, we're investing in the same asset classes at similar weighting. So there will be some good exposure to equity markets, both local and offshore. There might be some exposure to bond markets, property, etc., etc. But again, what we're trying to do is generate a return that is significantly better than those competitors. And if you look here, those return numbers over the last 15 years, quite significantly better than those competitors. Now, where we don't really play is something that is in the super high risk spectrum. So if I compare that to like an equity fund where you've got 100% exposure to markets, that's not a space that we offer a product at the moment. I do think that there are some exceptional hedge fund managers out there who are playing in that space and who can generate some outsized returns there. So if you are looking for that kind of high risk, high reward profile, then there are some fantastic hedge fund managers that do that. For us, it is about making sure that we give that risk-adjusted return profile that investors look for when they come to us. Why do we focus on protecting the downside? I mean, this chart shows it to you quite simply, but really it's for two reasons. Number one is to say, if you can protect on the downside, you're compounding from an ever higher base. And that means that over time, you can generate that exceptional performance that I showed you in the earlier slides. But it also means that you're not having to work as hard and put capital in harm's way the way you would if you suffer the drawdown. So, I mean, in the most extreme example here, if the market falls by 50%, if your investment falls by 50%, you'd have to double your money just to get to break even. So 50% down is not break even at 50% up. It's break even at 100% up from that level. And for us, I think as a fund manager, we obviously understand that then if you can protect on that downside a rand of excess return in a down market is worth more than a rand of excess return in an up market. And so for us, it's a case of making sure that we can hopefully consistently compound off that higher base. We are able to generate those returns without taking huge amounts of risk, without having to put capital in harm's way, whereas you would have to do if you were suffering those drawdowns in a fund that it doesn't have the ability to protect like we do. So I think key takeaways for today, trying to keep it short and sweet, is that we're a specialist hedge fund manager with a pretty exceptional track record. We've been doing this for a long time. I think we do understand hedge really intimately. We've stuck to our knitting in that space. Our funds provide real diversification, downside protection, and hopefully they're something that could add value to your client portfolio over time. Thanks for tuning in.